Welcome. This is Tax Pro Nation, the home of the independent tax professionals, where you can find a tax community, maximize your earnings, and live life on your own terms. I'm your host, Imelda Ledesma, COO of Pronto Tax School. In this episode, Daren and Andy will dive deep into the income and expenses of Schedule E, starting with how to handle a brand new client. Remember, Schedule E clients are on the rise, which means tax pros need to stay up to date in the fun world of rental income and deductions.
Okay. Well, I guess we'll hop right in. So we're kicking off. Andy and I had talked about it last week on the session that no handouts for today. That's why I think in the process of this is seeing we're building handouts for it. And so that's where we'll be going over information. I want to see where people's questions are at and where the focus is. And so we're building handouts at Pronto like we did for preparing Schedule C. And so working on kind of an all about manual, if you will. And so to kick off on Schedule E, how many people in here, or if you can raise a hand, probably most people are dealing with rentals somewhat here or there. They seem pretty common anymore, way more than in the past. People have really gotten into the rental market much more in the last, I'd probably say 10 to 15 years. Even though it's expensive, people seem to still be picking them up. And so good passive stream of income. But where do you start when you got a client that brings you in? If it's a new client, prior year returns, you have to get the depreciation schedule, everything else. But starting in today on Schedule E, let's say you got a new client, bought a new rental. So Schedule E, first off the bat, got to put down the physical address of each property. As far as setting it up, I do recommend, depending on what software you're using, is finding a good way to label things in your software so that you can make sense of it on the depreciation schedule too. Either name of the property or something to that extent. And then you have to pick what type of property it is. So first start with the address on Schedule E, 1-1, 1A, 1B, type of property. So now in picking the type of property, that's where you need to start off with the client. Is it a full-blown rental? They give you the choices: single family residence, multifamily residence. That'd be anything, above one. Then multifamily residence would be, 2 to 5 units, something to that extent. And then you get into apartment buildings. Today we'll be focusing on residential rental. Anybody here dealing with apartment buildings, things of that nature? Okay. Texas. Dealt with yurt in the desert. There you go. Doing Airbnb.
I have a couple of mixed units, like half commercial and half residential. And those are new that I've brought on, and that the rules are somewhat confusing on those.
Okay.
It has to be more than 50% in order to be depreciated as a residential rental building, different.
So are they like those live workspaces, or?
No, I'm talking about like if they have 2 apartments upstairs and they have a commercial space downstairs.
Okay. And your question is on breaking down the depreciation?
Yeah, well, that was new to me. So that to me was a little bit trickier. And then I guess the hardest part is when they're renovating the buildings. Like, to me, that's the most difficult part, is when they're renovating the buildings and they're either not all fully functioning or they're only partially functioning. How do you bring on different sections of the building as it becomes operable? Do you start off with the whole building? So that's been kind of, different.
Got it. And that's where one, cost segregation comes in. Two, you might have to break it down. That's where one of the rules too, as far as expenses like operating expenses become deductible. Here's kind of a key starting point is when it becomes available for rent. And so that would be your starting point for depreciation. So yes, you could have different portions of the building come online at different points for depreciation. And so that would have to be tracked by the client. And then you would begin operating, basically deducting operating expenses when it's available for rent, as far as if only half of it's available for rent and then like the other half isn't, I would probably take all the operating expenses, to be honest. But also depends on how much they are. And so if you have different units, I would probably track that property. You got the whole property, but then track it by unit and then bring them online as they become available for rent. Because that's the big one is people always ask, when can you start deducting expenses or when does it have to be capitalized? So that's where when it's a new rental, it's when it becomes available for rent. And so that's where with my clients, I always make sure that they have either signing up with a service that is searching for tenants, posting an ad online to seek tenants. Used to be in the olden days, just made sure that they had a photograph of a for rent sign in the window. But it is key to establish that date of being available for rent so that you can take operating costs as opposed to capitalizing those as prior to available for rent. And so moving on with just the form, and that's where the good part of this discussion is that while we're working on this is, and also why we want to build on it, and thank you for that, that there's no handouts today. That's where we're building them because we kind of want to see the trajectory that things go as far as the way people's questions lead so that we can build the handouts to make sense, not jump forward or jump around, because that's where it seems like with any starting point on a rental, then you run into all of these situations. And so that's where it's going to be important. But from the ground rules, we'll start easy as far as like residential, and then we'll build up from there. So on the form, you're going to want to pick if it's single family residence, multifamily, or commercial. And then once you go from there, or if it's land, I do have some clients that rent out just land. Now, the next item up is number of days rented. Does that give anyone here trouble as far as what to put for the number of days rental or number of days rented? Yeah. And so everything that I read, so that's actually a new line that they added. I can't remember. It was probably 10 years ago, I think, that they added that line to Schedule E. I think it was an attempt on the IRS to, catch more on vacation homes, things of that nature. Now, as far as it goes, what you're supposed to put there is the actual number of days rented at fair rental value. And so the bottom line, that's what the IRS says. I have changed tenant and owner decided to do remodeling. Is that considered? I usually exclude. Yes, so technically, so the way the IRS does it is that it's number of days that it's actually rented. So if it's not rented, and here's where a little bit of the confusion comes in, I think. So if, according to these rules of what to put on the Schedule E for number of days rented, is it's the actual days rented at fair market value rent. Now, if per Tiffany's note here, that if they're doing, if there was a change in tenants and they do some remodeling, is that considered number of days rented? She excludes. Technically, under what the IRS says, is it would be excluded. And so you wouldn't put down a day that it's not rented at fair market value. But that's where, at least as far as deducting, so you wouldn't include those in the number of days rented. But as far as I always make sure that my client is searching for tenants and making it at least available to rent or to be rented while they're doing these remodels, so that that we can still take some operating expenses, things of that nature, while they're getting it ready for the new tenant, because you don't want to put all those on hold either. The owner cannot find tenant in the case of bad marketing. There's no time frame on when it has to be rented, as long as they're actively seeking people to be actively seeking tenants. This is as far as operating expenses go. So if they can't find a tenant, how long can you stretch that out? There's no discernible time frame. It's not noted anywhere that if you hit X number of days not rented and they haven't found anybody, that it's deemed personal use or anything of that nature. But you got to make sure that you have a valid point that it really was available for rent, and that they were actively seeking tenants. And so, once you pass, I've had it take 6-8 months to find a tenant sometimes, depending on the market. But you also might want to push your client a little bit. Question, Marley.
If it's available for Airbnb purposes, if it's available for rent, even though it's not rented, you're saying that we actually have to, I thought it was as long as it's available for rent.
As long as it's
made available for rent,
you can deduct the expenses.
But those days, so if it's available for rent all year long, even though it didn't rent 365, you still put 365 days on the number of days, right?
I do, but you're not supposed to. Okay, that's what technically you're not supposed to.
But I thought that as long as, because otherwise it's going to prorate all the expenses only based on the number of days rented.
And that's what I'm going to get to is, kind of what the IRS asks for, and form instructions. And that's where I'm actually trying to find the law behind it. Form instructions are not tax law. They're just form instructions. And so that's where the form instructions for Schedule E say that to put on the number of days rented, you're only supposed to put the number of days that it actually rented at fair market value of rent.
But what about if you don't have any personal use days? So you're saying that if there's so then how the other 14-day rules would, it's just this weird that
it is weird. The way the whole thing is worded and everything else is weird, because it throws everything off when it comes down to the vacation home rules.
Because nothing makes sense then, because it's like, okay, then everything else is personal use.
Yes, even though it's not personal use because nobody's using it personally. So that's where the way that I do it is I put down for number of days rented is number of days that it actually rents and number of days it's available for rent. Yeah, that's what I put on the form. And so, and that's where, I'm honest with you guys about how I do things. There's ways that we do things in the world versus what the instructions say on certain instances, because that's where if that number of days, it's kind of can really throw everything off as far as, if you get into red flags, things of that nature. And so I got to say, like 99% of the time, the rentals for my clients under number of days rented just says 365. Unless, or I put the number of days. If they buy a brand new rental, I basically start counting the days since the day they bought.
Yeah, because the other thing is that apparently in an Airbnb, if you are there working on the property to make the property ready to rent, for the next tenants, as long as you're putting 4 hours or more that day, that's not considered a personal use day. That's considered a sort of part of the rental days.
Correct.
Because you're getting the cleaning, maintaining, repairing.
And that's where there's a little bit of a disconnect between the form instructions and the way that we actually do the form. And I think that's where everybody gets tripped up as well. And so, like Linda there, I just assume if it's available for rent, it's the equivalent of being rented. So do I. And so, never had an issue on it before. And even my clients, I've had audits on rentals, and they've never really, I've never had a audit on a vacation rental, but I'm assuming they may come down to those days that are on the form when they get into it. But if it's a full blown rental, I've never really had the IRS have an issue with it. In getting into it, unless they're really trying to hunt you down for vacation days and the whole 10% of time rented versus 14 days. And so when it comes down to the number of days rented, I personally include days available for rent and the days that it actually rents. But the form itself says that it's only the actual days rented. And so anybody else have any other questions on number of days rented? And so, okay. But so you do really want to find out from your client, though, when it became available for rent. And so that's really the bottom line there. And so moving on past that one, and personal use days, like Marley said, it's this weird gray area of what's an actual personal use day. And that's where, is it just vacant or did you actually use it personally? And so for like your Airbnbs, VRBO, vacation rentals, things of that nature, for a lot of them, I'll make sure that the clients, personal use days for them is what I'll put down as the days that they actually use it personally, that they either mark it out on the books. That's where I counsel my clients too, is making sure that it is available for rent on the websites and everything. Because if they use it personally, they usually have to notify Airbnb or the property management company, something to that extent, that they're going to be using it personally and that it is not available for rent. Crystal has a question here regarding what to depreciate on a newly purchased property. Closing costs and escrow fees, and we'll hop into depreciation when we get into deductions. We'll do kind of a basic round today, and then we'll have a whole Monday on depreciation itself, because it's a big topic. And so, because there's different levels of depreciation, cost segregation studies, I mean, it's a whole can of worms. So that's where we're just kind of keeping it to the basics of the form today. And so let's see here. Sorry, it's a little late. Are we talking about vacation homes or short-term rentals? David, we will be. Today, we're just going over the basics of the Schedule E, and then we're going to have more detailed Mastery Mondays going forward on the different topics, because we could have a whole day on depreciation. We can have a whole day on vacation rentals, everything else. So right now, we're just kind of doing standard issue Schedule E for a residential rental, and then we're going to expand from there. So key pieces of information you want to get from your client is, when it became available for rent, then you can calculate your fair rental days. Going forward from there, will you address QBI today or next session? QBI itself will be another session. And so, which we covered a little bit last week, but it'll also be baked in as well. So moving past from there, type of property is the next line after fair rental days. So you fill that out. So income. Want to make sure that your client is clear on what is income for the rental. And so that is rent received, including advanced rent. So rentals are on cash basis. So you do have to be careful with your clients and, make sure that they know as well to count actual rent received. So if a tenant prepays rent, in December, if they received the money and cashed the check and it went into their bank account, that's going to be rent for that year. You can't move it over the next year. So, any prepaid rent in a small span of time like that, you're going to be income for that year. Deposits are not income. and so they shouldn't be counted. So you really have to ask your client. So key things to get from your client when they're doing a rental is their deposit policy. Is it first and last month's rent? Is it security deposit? How are they doing their actual security deposit for the thing? Because security deposits you do not have to claim as income, and then also counsel your client that they need to track that. I don't track that in my software when the client receives a deposit. So does anybody here track that for their clients in the file or somewhere? Note anything like that?
I have
Yeah.
I have a property manager software. So I've only got 2 clients in there and I track it in there, but
Okay. And that's where to make your clients aware that when a security deposit can be taxable is when the tenant moves out. So if they keep any part of the security deposit when a tenant moves out, then it does become income. So you definitely want to, counsel your clients on what counts as income. As far as the IRS goes, they also say that income for the rental should be any expenses that the tenant pays for on their own. It's very loosely worded. I don't really track that one. Really what I look for is if they give them discounts on the rent for anything. So if there's a discount on the rent, as far as if they paid for a major repair themselves and discounted the rent, something to that extent. But then obviously there'd be, corresponding expense. So number 2, on top of that, you got to be careful of tenants that perform labor or services. That is technically rent received. And so let's say if somebody gets discounted rent of like $400 for helping service, a multi-unit or something to that extent, technically that is rent received. And so do I come across that very often? Do I really grill my clients on it? Not too much. And so, but you do have to be careful. And where that comes in is, since you're just beginning this rental with the client, you do need to make sure that they know that they do have to charge fair market value of rent. So I do look up on Zillow. I'll pull up the address and see kind of what the fair rental value is on Zillow. Now, it's not 100% correct, but it usually does give a good estimate of the area. Maybe pull up one other rental or so in the area to see if it's around there. But counsel your client that they do have to be charging fair market value of rent, or else they run into issues where past losses don't carry over, because you can't have a loss on a rental that you're not charging fair market value of rent on. And then also that goes for family members. If they rent it out to a family member, you better make darn sure that they're charging fair market value of rent, because discounted rent for family members gets thrown out all the time. And so they love going after that one. So you have to make sure that your client knows that they need to be charging fair market value of rent. Do most people here check that when they have a client setting up a rental? Make sure it's close. Anybody run into a situation where the client isn't charging fair market value of rent?
Yeah, I did just this last season. And
Okay.
I reached out to you about it and you were extremely helpful. I'm not sure if you remember or not, but it more or less had to do with the deduction rules, like the order in which we were able to deduct to the point where we couldn't kind of go beyond a loss.
Got it.
Right.
Yep. And that's what you do. And it basically it zeroes out at that point, and you can't take a loss on it if you're charging fair market value. If you're not charging fair market value rent, you can't go negative. Does anybody else go to the extent to verify that their clients actually received rent? So that's where you got to be a little careful, but that's just where your kind of sixth sense as far as clients goes come in. If something looks off or anything, I had to fire a client because they had done a 1031 exchange, and they said it was a rental the new one that they got and everything, and they were giving me rental income and all the expenses and everything else. And I had found out through a third party that it wasn't actually renting. So the client was just giving me phantom income and expenses. And so you do have to be careful of that. Make sure everything looks in order. I don't require a bank statement from my client showing actual deposits of rent, things of that nature. But if anything looks off or amiss, then you may want to also inquire just to make sure that the client is, on the up and up as far as the rent being received, because some people have, they'll put down rent that they didn't receive so that it looks active, and you got the rent coming in either to satisfy like kind exchanges, or that there may be significant depreciation, and so they're trying to take advantage of it and have the losses build up, things of that nature. So if anything does seem off with the client, good practice pointer would be to just ask them for a bank statement or something like that, show a deposit, something to that extent. I do encourage my clients to use property management companies just because it makes my life easier, and the property management company tracks everything and kind of takes the taxpayer out of it. And they give you the nice little reports at the end of the year. And so I do recommend that in the beginning. Also, I recommend to the clients that they do have a separate bank account just for the rental. This feeds into the QBI question that, we want to make sure that we set our clients up right to begin with. And so if there is, the opportunity to take the qualified business income deduction, one of those things is that it has to have a separate form of accounting. Separated from like not just everything in your personal bank account. So all clients, whether it's a new rental or over the scope of the last several years, I ask my client if they have a separate bank account for the rental. And if they don't, I tell them that they should set one up. And then that's where all the rental income goes, have the house payment come out of there. Things of that nature. If they need repairs, all the money should come out of there. They can fund it with their own money if it's short. And so, but those are the types of things that those are the questions that can bring more information out, in that, if you tell them to set up their own bank account for it and everything else, and they're like, well, there won't be enough money in it. It's like, well, are you not charging enough fair market value of rent, or why are you doing a rental if it's going to be that big of a loss? Depends on how much the house payment is, everything else. So, but it's a good rule of thumb just to tell them to have a separate bank account to begin with. Sona, question.
Yeah, quick one. I had a client who bought a house and moved his dad into it. And the dad contributed a little bit from his Social Security every month, but the property tax and the mortgage interest far outbalanced anything there. And it wasn't fair market rent, the Social Security contribution. And I just told the client, this isn't a rental. And I didn't even report it on Schedule E. Is that wrong?
That's the way I would do it.
I mean, it's a total wash anyway. It's basically just he's helping his dad. He's helping.
It's more of a second home, and his dad's just kind of contributing to that.
That's what I thought. Yeah,
it is really what it is.
Okay.
And so on that one, I don't. I don't write those types of situations up. Separately,
Okay.
Unless it's close to fair market value of rent, or if one's like my kid moved into it and they're making the whole entire house payment, that's a situation that you run into all the time. And which on that, and I know we can go down several rabbit holes on that as well. And so what I will say on it is we will do a Monday on weird stuff that just doesn't quite line up. And so today we're just doing the basics. And also that's where I want the feedback from you guys, so that we can, detail this properly, get the manuals built to help everybody out. And so far, but as far as expanding this goes, we'll have rental setup, depreciation, and then also depreciation ongoing, how to handle that. So it'll really be, we'll have a whole Monday just on depreciation, which will include setup and also improvements, things of that nature. We'll try to cover the whole entire thing. We can probably do a whole Monday on renting to family members or like odd rental situations. Does that sound, would that kind of be a group of like a rental that just doesn't quite line up and how to tackle that?
Yeah, I was going to ask about something. Like, I'll have friends that will move into their girlfriend's house or vice versa. And they're like, oh yeah, I just pay her rent. And I'm kind of like, man, maybe you should change your terminology. Because when I hear that, I think Schedule E. So I'd like to know maybe how you approach that. I usually tell them, like, hey, how about you pay for the groceries and utilities? And
yeah, it's more of like a shared living expense. You didn't really turn, and I think that's also the like personal nature of the relationship, or even, how does it work with roommates? Things of that nature. So I think there's a difference between shared household expenses and when something is actually a rental with like an actual landlord tenant agreement. But also it'd be good to see, that's where I'll pull some more information together and everything else so that we can see where the actual IRS guidelines are on that, to make sure that everybody stays in the clear. And so we can do a whole Monday on like shared renting, roommates, girlfriends. And also what we'll do is mix into that is also mixed use property. And kind of all the oddball stuff you see. Like I have a client that she Airbnb's 3-bedroom. And so for long-term stay over 30 days, it's not even one night or 2 nights. Like she rents out bedrooms to several people. And so in that note, they become an actual roommate, but I have it set up as an actual rental because it's like $1,500 a month for a bedroom. And so, but we'll get into, breaking down the property, the percentages. Yeah. Renting by the room in your home to unrelated partners. I have a couple of those. And so we'll have a whole Monday on that one as well. And then let's see here. New client had to fire them. They made up rent amount for their triplex that they rented out for their business. Yeah. So see, there's one there that no rent actually exchanged hands. People do stuff like that to, that way they get the depreciation deduction. Also, they're trying to take the mortgage interest, property taxes, stuff like that on a second home, or if they're over the $750,000 in debt when they buy a second home, something to that extent, they try to come up with all kinds of crafty ways. And so you definitely want to make sure that you protect yourself. And so one of those ways is to, tell the client to open up a separate bank account, and then possibly check deposits if you have to, if it feels like something is off. Hopefully you're not working with people that would do stuff like that, but it happens all the time, unfortunately. And so moving on from there, so any questions on, well, David had the question on rent received, so I think got a pretty good line on what's rent and what isn't rent. If you've got a family member. Okay, here's another instance, like, okay, grown person, their kids are in their 20s, kids are contributing $200-300 towards the rent on the house. Do we report that? I don't. Does anybody else here report that as rental income? Or somebody's kids giving the parents money for rent? How about in California? Do you put down the renter's credit for the kid? No. Yeah, I don't either. Unless they got a lease signed or something to that extent, I don't go that far. Plus, it's not really worth it for the $60 deduction in California. And so, Sean, did you have a question? It was on renting room. Unrelated.
You cover that, just.
Yeah, and we'll cover it. A quick synopsis on it, though. I broke down the house based on square footage to depreciate. And so for the space that they're doing, as far as for the mixed use space that they're using, I expanded a little bit. They have their own bathroom over there and everything else, but I basically broke it down to the area that the tenants are using exclusively and took the depreciation that way, and then use that percentage to tally up the shared expenses as well. And so Tiffany Lowe had a question. Rarely I see a property manager combine two properties they manage for the same owner in one statement. I still do try to break down between the two properties. I once saw a Schedule E with two properties combined on one column. I split it in the year that I did the tax returns. Tiffany, question for you. Do you mean two separate properties, like two separate addresses, or like a 2-unit?
Two separate addresses. Yeah, it's kind of weird. But I ask a lot of questions to try to break it, because I feel if it's two separate properties, when they sell it, they need to have the individual property separated, if I see anything like that, I usually, at least the year that I do it, I don't go back per se, because sometimes the rental might have happened for many years, but I use like spreadsheet to divide the properties. And then I have to, backtrack the depreciation and stuff like that. But and then it's a separate case where I have seen a Schedule E with two properties. I think in that case it was like two different units, but it's in the same development. You know how there's a community and like townhouses, and then there are two different units really, but they are in the same townhouse community. So I also separate those.
Yeah, I always have those separate. So my rule of thumb is, if it's got its own address, well, not necessarily its own address, but so how do you break down your properties? It gives you column A, B, C, all the separate properties. So if it's several units in the same property, that's one property. And so, but if you have two separately distinct, like even if they're next door to each other, if you have two separate condos,
yes,
that have two separate addresses, two separate everything, then that should be two separate rental properties. And right. So I
go by how, like, if you were to sell it, can you sell it separately? That's how.
Correct. That's a good question to ask. And so now my depreciation schedules for ease of the client and everything else, I might break things down between Unit A, Unit B, Unit C, things of that nature, or even in like a triplex. The triplex itself may have three separate addresses, but they're all connected, part of the same building. So you can't sell just one of those addresses. So like Tiffany said, is if there's any question to how to separate, if the properties should be combined or separated, is just ask the client, and look at the purchase agreement when they bought it. Is it just one entity? Was there multiple escrows? Things of that nature. So when you're putting the properties on Schedule E, you wouldn't want to combine two separate distinct properties into one column. That could lead to all kinds of problems. And so also one thing that we'll get into on another discussion will be elections on grouping, which is something that if you're not grouped, you wouldn't want them to be grouped together, because when you sell a rental property, it does free up all the prior. If it's a complete disposition, it frees up those passive losses, those prior losses, if they weren't allowed to take them. And which we'll have a whole Monday on rental losses, when you can deduct them, when you can't, how they carry over, and the different things. So there will be a whole day on losses and what to do with them, which grouping comes into an issue on that, which is cool. And so, and then that's where the only time as far as and breaking down depreciation goes now, who was it that had the mixed use commercial and residential in the same building? Was it Grace?
Yeah, it was me.
So now for you, are you keeping the price? It's all one space. Are you reporting it on one column on Schedule E?
No, I don't think so because because we have different, no, for the building itself, let's see here. For the building itself, we have no, we're depreciating them by the unit because the half of the unit went online first. So we divided everything up. We divided the cost of the building. I took the building, I took the portion of the building that was usable because the rest of it's under complete renovation. It has never been rented out since this owner's owned it. And so I took the portion that was available and I started a depreciation schedule for that half of the building and the renovations for that half of the building. And then I started, deducting it against the rent. And then the rest of it hasn't come online yet because it's not usable yet.
Okay. And so you're putting them as actually separate properties on the Schedule E.
Yeah, I didn't see any other way. I talked it over with a lot of different people. I didn't see any other way to do it because the one wasn't online and it wasn't finished yet. And the other one was operating.
Got it.
So, I mean, how would you have done it? Would you have depreciated the entire building and then?
Between it there, I'm actually for everybody's benefit, I haven't separated properties out. I would have probably kept it all under one column because it technically isn't two separate properties. You wouldn't be able to sell them separately. But let me double check on that for everybody as far as taking one property and breaking it up into separate properties on the actual Schedule E.
I asked a lot of people and I got a lot of mixed answers on that, a lot. And it wasn't really super clear in the reg, like how to depreciate.
It's not. And that's where on a lot of these rental issues, the law isn't very clear. And so
I guess basically what we did is we took the building itself and we said, okay, this is the cost of the building. This is the cost of the building that's in operate. This is the portion of the cost of the building that's in operation. So we
and put it into one, so it's 365.
And then we took the renovation costs and we put that one into another depreciation.
Yeah, because it's not going at all, and then that way it's its own property column, its own fair rental days. They are completely separate units. So let me double check on that. That sounds right to me because of the issue of them not being available at the same time. But I'll have an answer for everybody on that next week.
In addition to that, and I know this is a depreciation thing, is in addition to that, that was the thing about, because half of the building is residential and the other half is commercial, but there's some rule somewhere that I read that if it's not more than half residential, you have to depreciate the whole building as commercial over 39 years. So you couldn't split it up that way.
Residential. I will check that one as well, because we're going to be dealing more and more with it with the mixed use properties, because I know they're building a lot of those here in Orange County. I don't have one for a client yet, but a lot of these mixed use, live work units, commercial downstairs, residential upstairs, things in that nature. Those properties are becoming more and more prominent, and so I think it's something we'll see more and more.
In a way, it's kind of easier because some of these properties that I have are just they're being renovated and they're kind of coming online in sections. Like I got a big building, downtown building, which is rare because we don't have a lot of downtown buildings where I live. And so this is a rarity to even get one of these things. but it's commercial, it's residential, and eventually the owner is going to live in one of the apartments. So then it's going to be
personal.
primary.
Great.
Yeah, it's a festival of delight.
Oh yeah.
So while you're writing things down, I have another little heartburn thing. So you have somebody like me and like one of my main clients that have a lot of rental units. And so I have an issue with, and I'm trying to be as, dedicated as I can be, but now that the more units that I have, the more combined costs I have, like as far as like equipment that I have, that I need because I've got so many units, that kind of stuff that does not assign to one rental unit. It's like, stuff that I use for all my rental units. Or like I have an employee that I hire.
And you're talking multiple properties and everything else.
And so like, Andrea was saying, well, if you have an employee, technically you're supposed to, split out all the hours. That would be a nightmare. Like, so I just kind of take it off on one unit. I mean, I take it all off on like the main unit or the one, but I don't know. That's something I wanted to talk about too, is because that is a nightmare having to split. Okay, so she worked 2 hours at this unit today and then 2 hours over there at that unit, and then she was here back and forth. And I mean, to me, that was crazy. And there's a spot on the oh yeah, and then thing about wages is another whole thing. And I know that's rare. Not very few landlords have employees, they usually have go to management companies, so they're.
Yeah. Well, and that's where, and Sean in his note, and that's where about I was going to come to, is that we'll have a whole session on like multiple properties when you own a lot, dealing with real estate professionals, also if they have multi-units, things like that, because a consolidated management company is potentially one way to do that, where you have a company. A lot of the times they'll set it up with multiple LLCs and then have like an S corp, something to that extent, own the LLCs, or an LLC own those LLCs, and you have a property management company on the top that takes all the overhead across all of the properties. And so as far as multiple properties go, or, once you really get into the real estate professionals, or I don't want to call them professional renters, but people that have a large amount of rental real estate, that will be its own Monday as well. And with Jamilda, I'll type up all these notes and shoot them over to you and Andy as well.
Okay.
And then we're already at 10:51. So let me hit the chat questions real quick. How do you transfer personal rental property to LLC? And Kita, do you mean personal rental property like personal property, like cars or equipment or things of that nature? Is she still in? Because that's where you have to be careful too, is on your phrasing. Personal rental property, do you mean like a house that they were using personally, or actual personal property?
Personal in the sense previously the rental property was under Schedule E without LLC, right? In the personal name. Now the client wants to open an LLC, and they should we be transferring to in the LLC by the book value? Or should we be doing a sales transaction, because it's a single member LLC they want to open for the liability protection?
Is it going to be a single member or multi-member?
Single member.
So it'll still go on Schedule E, disregarded, but we're going to have a whole session on entities.
Yeah, I would appreciate if we could, because I see a lot of inquiries, or a lot of, the clients are willing to do this for their personal liability, protection over the rental properties.
Yep. Okay. Yeah, because we're going to have to coordinate because I know the other mentors are covering some of these topics as well.
Sure.
And so that's why I
So
wanted to see today
the
to get
most
out where
important thing
everybody's
here,
focus
like
is at.
what should be the basis we should take when we transfer? Because sometime, most of the time they do through quit claim. So, but so they can through the quit claim they can transfer the property. But what we should take as a basis, like a book value, or should we be doing a sales deed, which is not very much beneficial, I believe.
Yeah. So general rule of thumb though is when you transfer, it's their basis. So fair market value doesn't really come into it. But we definitely will cover that topic. Sean, we covered, yes, you can set up management companies in which can be in the client's interest if they have different things that they're paying for that apply to multiple properties. Can owner take tenants out for meals within reason? And which line do you deduct this expense? I've never had a client take a tenant out to a meal. I've had them put them up in hotels and pay for meals, like during a renovation, things of that nature. That we just deduct. You can put a line item, so that's where too is the Schedule E does have other line 19, and so it's not like Schedule C that 50% it halves it for you. So on that note, I guess if you took a tenant out to a meal, I guess to discuss the rental or something to that extent. You could put, management meal at 50% on the Schedule E. And then retirement plan contributions for rental business, they will need to use LLCS Corp. As Form 1040 Schedule E is passive, not considered earned income. Yeah, so that's a whole different structure, Tiffany. If you wanted to do retirement plan contributions on the profit and everything else, that'll come into entity structures and having multiple properties, which also comes into ours to get that passive versus non-passive income. And so we will definitely cover that. And we're at 10:55. See how quick it goes with rentals? Well, I think we got a good footprint on what rent is. And the top half of the form. So next Monday, we'll go deeper dive into the expenses portion of the Schedule E. And then with covering the expenses, we've covered income. Next Monday, we'll cover expenses. And then that will also lead into, is it a profit or is it a loss? And so based on that, we can cover some of the passive activity rules on rentals and how suspended passive activity losses work for rentals. So in closing, that's as far as we made it today, but that's where I'm going to do the best I can to answer your questions and go over the topics, and why I'm trying to stay focused, because rentals are such a can of worms. So I'm going to send an email to Emilda and Andy about today. We'll coordinate with the other mentors as well, so that we're not doubling our efforts. Any last quick questions?
I have one question.
Okay.
Okay, it is like recently I'm seeing the client is forming one LLC, like a multi-member LLC, which doesn't have a rental property, but that multi-member LLC is collecting a rent for their other rental properties. So how do we give a impact to those rental income and the expenses, which is basically okay. So suppose they are having two rental properties, which is reported on Schedule E of 1040. But they created a multi-member LLC, and that
That's
LLC
just collecting the rent.
yeah. So how do I report that rent? Should I be showing it as a loan shareholder? Or
So we'll cover that in the entities portion. Really what they did was they created a management company.
yeah, but it is a self-management, like in their own name. So it's it doesn't sound me so great, like sending themselves only the 1099 miscellaneous, and taking the commission from oneself.
Yeah, which that would be the actual income. So I'll cover that on the day that we do LLCs on that one. That's not a short answer. It's a very specific situation.
So could we be discussing next Monday about this, or?
I can cover it a little bit more, but I'm going to work with the team on Pronto's end to get kind of our table of contents together on what we're going to be covering each Monday going forward. But I know that the LLC is a big topic, so we'll try to get it scheduled very soon.
Sure.
Yeah, because on that one, because with the multi-member LLC taking the rent in, really they created a management company.
Yeah, both the members
it's not the rental themselves because it doesn't
husband wife only.
rentals.
So it's like husband wife having multi-member LLC and husband wife having reporting those on 1042.
Yep. Yeah. So I'll get an answer for you on that.
Sure. Thank you.
Okay. You got it. All right. Well, thank you for your time, everybody, today. I really appreciate it. And we'll dive in more next Monday. And so we'll get into expenses and passive losses next Monday. And then I will coordinate with the team here on Pronto's end to schedule out the rest of August.
Thank you. Have a good day.
Okay. Thank you, everybody.
All right, bye-bye.
Bye-bye.
Bye. Thank you for joining us. I'm Imelda. Join us next week as we continue to share mini audio clips of Schedule E tax prep process. If you are interested in listening to the full process and want to be part of our Dream Team community, please visit prontotaxschool.com or email us to support@prontotaxschool.com. Being part of the Dream Team membership comes with getting expert support, top-rated training programs, and weekly video live events. We look forward to having you on board.